So I know a week ago you might have had a different answer. Today we tested some new lows at 34.91 on the S&P. Do you have a new support level for the S&P? And what do the technicals tell us about the potential moves going forward?
Yeah, it's a great question. Listen, 34.91 is the tactical players line in the sand. But ultimately, I think that the next level we're going to revisit here, assuming this bear market continues, is around the 3,300. And that's because that's where the pre-COVID crash lines up with. And you've already seen a handful of stocks start to revisit those levels and even below in real estate and communications, some tech names. So as evidence builds that more and more stocks are retesting their post-COVID highs, pre-COVID highs, and even some of the lows in the case, the market likely has to go there too structurally. I think in the near term, you've got a good fourth quarter seasonal as a tailwind. You can get the S&P to say 4,000, perhaps even a little bit higher. That's in line with typical bear market rallies. But I would not overstay your welcome here. The trends domestically and abroad are still very much negative and a headwind.
All right, so you're seeing a lot of negativity potentially in the future when it comes to technicals. Let's also talk about bond yields. They briefly tested 4% earlier today after that hot CPI report. What do you see as the resistance level for the yield on the 10-year? Again, we hit 4% earlier.
Yeah, 4% seems to be a little bit of a magic number here the last couple of weeks. But, the way we're looking at this is the structure, the regime of yields has changed, and yields have been much stickier than the consensus has expected this year. Yes, maybe they're a little term extended in the short term, but we continue to believe the trajectory is higher. Yeah, I would not be terribly surprised if you start to see 4.5 or even a 5 handle on yields as we head into 2023. The way that tech stocks have acted, the way that some of these growth stocks continue to act, they are not leaders. So that would suggest that the trajectory for yields is still higher. Conversely, you see energy continuing to act well. The financials have shown some signs of life. The industrials are showing some signs of life. And that's consistent with what we believe is going to be higher rates over the course as we head into the next year.
Let's talk a little bit more about inflation. It's obviously a backward-looking number that we're pondering and stewing over here this afternoon. And the Fed really only started to tighten, let's say, 6 months ago, in March, thereabouts. And some of the tightening on the balance sheet has been sort of de minimis so far. Do you think that inflation is about to fall? Because it seems, at least on those backward-looking year-over-year numbers, and even month-to-month, it's not falling much.
Yeah, this is a great question. This is the question I think everyone wants to know. The most important takeaway I can offer, right, is that wherever inflation settles, whether it's at 5%, 4%, right, even 6%, you have to get the Fed funds rate above that number before we're done hiking. I think that's the bigger
what Larry Summers says. That's the Summers point, right?
Yeah, our chief economist, Don Rissmiller, has pointed out, Jason Trenor's pointed out, that is the biggest takeaway, I think, from the market, that you need to get Fed funds above the CPI before this is all said and done. And I think this goes back to the 3,300 number in the S&P, is why we're just more structurally bearish than the reversal today would exhibit.
So, Todd, we're bringing you on to talk technicals, but I want to talk to you a little bit about currency, too. How much does the move in currency play a part in your thesis, especially when it comes to the moves for the S&P? Obviously, a higher dollar weighs on a lot of these companies and their revenues when it comes to overseas markets. Right now, we've seen the dollar soften a bit, but still up 17% year to date.
Yeah, the dollar has been a Mack truck driving through risk assets this year. I think the consensus believed we were in for a weaker dollar earlier in this year, and the total opposite. I find that it's amazing that the Bank of Japan tried to intervene in the yen market a few weeks ago, and we're already above those levels after a $20 billion intervention. And so until you can get the boil off of the dollar, right, maybe back to at least 109 is the first test of support on the DXY, that keeps pressure on global markets. And so if you're going to see a real move, durable move higher in equities, you got to get the dollar lower. That's going to give a boost to risk assets abroad and some more risky corners of Europe and Asia. But again, 109 in the near-term support, and that still doesn't change the overall trend for the dollar, but at least brings off the boil here for perhaps a fourth quarter rally in the near term. Again, yen still weakening, yuan still weakening. The dollar is a persistent headache for risk assets abroad.
All right, DXY right now at 112. You're saying 109 is the key level. It is a little bit softer. Todd, we appreciate it. Not bringing a lot of sunshine today, but we appreciate the insight. Thanks for being here.
We like the light.
Market. Thanks, Frank.
Shepard Smith here. Thanks for watching CNBC on YouTube.